The S&P 500 and NASDAQ both trying to start the week with all-time closing highs. But does this record-setting rally have much more room to go? Let's ask Max Kettner. He's the chief multi-asset strategist at HSBC Global Research. Welcome, Max. Good to see you.
Thanks for having me. Thank you.
Good to be a multi-asset strategist when multi-assets are rallying. Does that continue?
Yeah, I think so. I think what we obviously had last week was this sort of confirmation of Goldilocks and really a rally across pretty much everything. But when we dig a bit deeper, actually what we can see is that, when we look at treasury yields, both 2-year and 10-year, for example, they're back to the levels where we were pre-CPI. So it's really the strength in spread products and credit spreads and high yield and IG and emerging market debt in things like equities, whether it's US equities, whether it's European, Japan, whether it's emerging markets. It's really the strength and risk assets that stands out. And I think the reason is very clear. The reason is that the market in April got really worried about this tail risk of will the Fed need to hike again? And that hike word is now gone. It's firmly gone, really, from what we've heard from Powell during the last FOMC meeting. And I think that got confirmed last week with the data that the next move is going to be a cut. And for equities and for high yield or for EMD, so if you're long risk assets, it doesn't really matter whether the first cut is going to be in June and July and September, December, as long as the Fed keeps telling us, look, we might not have the confidence just yet, but give it 2-3 months and we'll have it. That's good enough for risk assets to rally further.
For how long?
Yeah, I think we're going to have a couple of months at least still. So I think it's going to be really until sort of the Q3 reporting season, perhaps, where I see a couple of troubles brewing. Because when we look at the Q3 reporting season in the US in particular, that is where expectations are basically shifting away from tech, from the Magnificent Seven in particular, towards the broader market. And then, if growth is on a firm footing, if growth is fine, but it's actually not as good as we expected, and the earnings growth in those other sectors, in those other 493 stocks, cannot exceed expectations as perhaps those seven stocks of the tech sector has done in the last couple of reporting seasons, that could be a bit of trouble. But that's 4-5 months away.
Noticeably absent from your view on where to invest around the world. I know we just showed you like Japan, you like the U.S., obviously. Europe's not on your list because there is a suggestion. We had one earlier today from Aaron Brown of PIMCO, for example, that go where the rate cuts are going first.
Yeah, but I think, look, in terms of Europe, when we look at euro-dollar, for example, most of it has been priced. When we look at rate expectations or rate differentials, bear in mind, both ECB and Fed rate cut expectations, they started the year around 170 basis points. Now we've seen that divergence really creeping in the last 2.5 months, so that's kind of priced as well. We've also seen that on the long end of the Treasury and the Bund curve, that there's a bit more of a difference being priced now. So both in rates and in FX, it's being priced. I think in equities, when we look at the larger caps, they don't have an awful lot to do with GDP, right? When we look at things like, luxury goods or things like obesity drug makers or even, things like AI-related stocks in Europe, they don't have an awful lot to do with European GDP. Where I think it really, really is worth a shot is in Eurozone small caps. Because when we start to see now really China stabilizing, we're really starting to see also that growth expectations, particularly top-down growth expectations in the Eurozone, are starting to be revised upwards. And the only real cyclical part of the equity market that hasn't really baked that in, to me, is really Eurozone small caps. So it's the Eurozone small cap segment that is really, really worth looking at here, not really the broader European large cap equity market.
Got it. Max, we'll see you soon. I appreciate your time. Thank you. Max Kettner joining us.